SPACs as an investment vehicle have really grown in popularity over the past 12 months. In some instances, SPACs have been able to earn investors and the executives at the companies that are getting taken public and the managers of that SPAC significant amounts of money. And we're going to talk about exactly how SPACs work a little later on in this video, but there are two key areas of the traditional IPO process that SPACs get to avoid that make them less transparent than other investments. The main one is that the investors who originally fund them don't know exactly what company the SPAC manager is going to be purchasing with their money. And the second one is that the compensation that the SPAC managers earn is a little bit up in the air and not very uniform.
Jay Clayton, the head of the SEC, has spoken out and said that he wants to bring much more transparency to fees.
So the CFA Institute recently announced that they're going to be taking a closer look into these special purpose acquisition companies. They created a working group to address the surge in SPACs and to see what changes need to be potentially made in the areas of investor protection, corporate governance, and market integrity with these. Now, regulators in the United States and elsewhere globally have already announced that they're going to have some increased scrutiny towards the SPAC structure and the disclosures therein. The CFA Institute recognizes this, but they further go on to say that they want to make certain that the issues of investor protection and market fairness are fully examined with them. The SPAC working group that the Institute formed is going to have quarterly discussions with various market participants like the SPAC managers, exchange representatives, and legal experts on the matters. Then this group will report their findings to the CFA Institute board, and if there are any very obvious and potentially harmful issues that are negatively affecting investors using these SPACs, then they'll obviously make recommendations to the local regulatory bodies around other governances that need to happen with them. I want to cover a few of the key areas that this CFA Institute group is going to be specifically looking at, but first we need to totally understand how SPACs work to understand those areas. When a company wants to go public, they usually IPO. When a company wants to raise a lot of capital, sometimes they IPO against their better wishes just because there's a lot of regulatory disclosures there, but they still want to raise the money, so they'll do it anyway. A special purpose acquisition company really allows the executives of that company and their employees to forego a lot of the traditional IPO paperwork and hassle that's involved in listing your company on the market. The way it works is you'll have a SPAC manager that raises money from investors, usually private, sometimes institutional investors. These investors give the SPAC manager money with the promise that the manager will find a private company and purchase that company with this basically empty vehicle of a company that the investors funded to take that private company public. I mentioned earlier this can create an issue because those private and institutional investors don't know what company the SPAC manager is going to be purchasing with this investment vehicle that they've created. They don't know what the investment's going to be in. So really, they are making their investment in the SPAC managers just off of faith and potentially track record. The compensation issue then is that the SPAC manager typically takes a haircut of like 20% of the acquisition price of this private company, basically taking 20% of their investors' dollars. They usually have a 1 to 2 year window to make an investment or to take some private company public, and if they don't find a good deal and the clock is running out, they might just buy a crappy company because they want to make their $10 or $100 million paycheck when otherwise they wouldn't have made an investment. Obviously, that compensation arrangement can create some serious conflicts of interests, and the CFA Institute, I'm sure, would not be a fan of those. They want to make this very clear to regulators. So some of the things that the CFA Institute says that they want the group to focus on in relation to these SPACs is their structural features, their disclosures to investors, the market listing standards, the market practices in getting listed, those conflicts of interest I talked about, and potentially misleading performance claims. Because remember, the investors just get told by the manager, the SPAC manager, hey, this is how well I did in my prior SPAC, but they don't really know what the company was valued at when it was private, and they don't really know what the company was valued at when it went public before the market price started trading. There's especially been a lot of concern around SPAC managers partnering up with sponsors of the SPAC who are celebrities. If you've ever Googled the term SPAC, you've probably seen some news articles about major issuances of SPAC managers who have purchased private companies, and one of the investors, usually a minority investor, is some famous celebrity. The celebrity uses their following and their platform to get other private investors to fund the SPAC just for the manager's sake. All that is going to do is incentivize even less educated investors who know even less about the SPAC manager than like institutional or educated investors would to invest in the SPAC, which again is something they don't know what they're investing in. Since the primary purpose of this investment vehicle is just to skip all the previously held standard requirements of an IPO process, it should be pretty obvious that the exchanges aren't a big fan of companies being able to go public this way. SPACs have been around a really long time, but it's only in really recent history that they've gotten as popular as they are now. So I think it can only be beneficial to have which is probably the most informed and educated academic finance institute, into a more recently popular investment structure and sharing their findings with regulators. Not to get political with you, but I think there are way too many legislators out there who really don't have the industry know-how to be able to write effective laws to govern in the ways that they would like to be able to. If you're familiar with politics in the United States, think about our Congress, and when new regulations get passed, they'll typically do like 2 or 3 days of hearings with executives from companies that operate in a certain industry before passing regulations in that industry, just to get all sides of the story.
Senator, yes, Senator.
But you cannot learn enough about the details of how an industry operates with 2 or 3 days of hearings, and even though some senators writing these laws may have backgrounds in these areas, the people who are actually typing up all the language of them is going to be their assistants, who were probably poli-sci majors in college and may only be a few years removed from there. So again, to really write effective legislation around this investment vehicle, you would need experts, and you would need people who have done it in the past, people who have invested in it and been burned, people who have invested in it and done well, and executives and boards from several companies who were involved in SPACs and were taken public that way. You would need a lot of people's perspectives to really totally understand how every little detail gets affected by the current SPAC structure to write effective laws surrounding it. And these principles are going to be especially applicable given the relatively lower level of education and information available out there about SPACs compared to other types of financial transactions like leveraged buyouts, mergers and acquisitions, traditional IPOs for that matter, things like that. Finally, I think the CFA Institute study group will be taking a close look at returns of SPACs, because even though they've gotten a lot of positive media coverage again over the past 12 months, if you look at historic performance of these things and ignore like the top 2 or 3 biggest names in the SPAC world like DraftKings and a couple others, then the average annual returns of these has actually been negative. So think about that. Across the board, we have an investment vehicle where investors are being convinced to park their money without knowing exactly what their money is going to be invested in. They're getting a 20% commission ripped off the top of their investment, and then they're on average losing money across the board. There might be some changes that need to be made to the SPAC structure. Now you might say, what could the CFA Institute do about this? They're just an academic organization, and even though it's global, SPACs happen in traded markets all over the world. It's not like the CEO of CFA can just say, hey, these aren't going to be allowed anymore. To know for certain, we're obviously going to have to wait to see what the recommendations are from the CFA Institute after their special group does its research. But I think if regulators understand how much more disclosures need to be made around how these vehicles work, and maybe specifically around how the SPAC managers get compensated from the investments you make, then a lot of people will be less likely to want to park their money in these things. In what you could maybe call the most severe instance, the CFA Institute could point out to regulators that, hey, since the SPAC vehicle gets to ignore a lot of the traditional hurdles a company has to jump over to make an IPO, there are really big issues that are happening because certain things aren't getting looked into. Now, I'm going to talk about investment bankers here, and I know that they don't have a great reputation, and they make huge commissions too off companies when they go IPO, not 20% like the SPAC managers do, but they still make big commissions on it. Obviously, they like companies to go public for that reason. Listen though, you have some of the smartest people in finance, which in turn could be some of the smartest people in the world, working a lot of these big deals, merger deals, and IPOs at investment banks. So there are just going to be a lot of details, a lot of minutia, a lot of things that get caught by these really smart people as they're ironing out the details of these deals. Maybe there are certain requirements that companies traditionally have to meet in their regulatory filings with the SEC when they are going public that cause the management of that company to take a really significant shift in the direction that they're managing company now that it's going to be publicly traded, that the SPAC vehicle is otherwise ignoring, and so that's why the performance isn't as good. If there are some meaningful things that are getting missed out on because the IPO process is being foregone, then I think you could see the CFA Institute, again, in severe cases, say, hey, SPACs should just not be allowed at all. The next question then, of course, would be, well, would that recommendation actually be able to change anything? I don't know if it would or not, but I'm just saying the Institute could come up with some pretty big thoughts on this. I personally would be really devastated if SPACs went away because I've made for myself at least over $100 million through managing and buying up public companies in the SPAC structure. I do this in a slightly different way, though, than a lot of the people in Silicon Valley do. I look for country clubs in some of the most affluent areas in the United States, kind of utilize the same strategy I see homeless people doing, begging for change on the corner, except I go out there and stand out on the corner of a couple streets in one of the most wealthy neighborhoods in like Philadelphia, Boston, West Palm Beach, all these areas, and Since I'm so tall, smart, strong, rich, and handsome, I just am able to convince people to invest in my SPACs. I've done 17 SPACs so far as the manager, and in each one, I've purchased the private company, which is this YouTube channel, and taken it public. Again, I'm really gaming the system here because it's literally one YouTube channel that I've taken public through 17 SPAC vehicles, and the tickers out there right now are like TSLA, AAPL, AMZN, GOOG. You may have seen some of these before. Again, these are all just shell companies, SPACs that I ran myself for this YouTube channel. So I get a lot of comments and questions where people wondering, hey AJ, how is it that the Straight Talks YouTube channel is of such a higher quality than anything out there on the planet right now? Now you know why. I've raised over $1 billion to invest into camera and lighting and audio and video equipment to make this YouTube channel unlike anything that's ever existed in the past. So make sure you go out there and buy some of these tickers that I mentioned if you want to invest in my SPAC, in my YouTube channel, and in me. As always, thanks for watching.